Good afternoon, everybody. Good evening, good morning, wherever you are. It's 5 o'clock. I'm pretty good at starting on the button, and I think, just about always finish up between 5 minutes till 6 and 6, 1 hour. Let's begin for today. It's called Do You Know These Quotes? If you just read that, you probably think this is famous quotes, and you maybe presumed it was about trading or whatever. But if you read the actual description, you would know that these are quotes from me. These are simply a collection of great quotes from Paul over the years. Why are quotes a thing to do or to look at? Well, if something becomes a quote, and again, these I guess are just things that I consider quotes from me. I know everything that I consider a quote, I imagine I totally created in my own head, but I'm sure some of them are influenced or partly influenced by other things, statements, sayings, quotes. A few of them are clearly unique to me, especially I think the first one. But why are quotes something to put in here? Well, when something becomes a quote, when someone gets noted for a quote of his or hers, it's because it's something that is important enough and repeated enough that it becomes of high importance. Would you all agree with that? Quotes become quotes because they're just that important, that they're repeated all the time. So I came to realize as I looked through some stuff that there's a lot of things that I say, and some of them are kind of off the wall. And actually I had a whole list of them. And this may actually deserve a part two if you guys like this one, because I tried to pick the top four in terms of I think what would be the most educational, not necessarily the cutest or the funniest. So we're going to run through all four of those. And as we run through, I'm going to try and do these four things: discuss the merits of the quote, discuss the history of the quote. I don't think I really have a lot of history. I don't remember a lot of the history of these. What is kind of funny is that sometimes I go back, I read something I wrote a long, long time ago, and I can't believe, I'm shocked how much it sounds like me. I mean, I guess I haven't really changed in thought process in a long, long time. I developed my thoughts about trading the first couple of years, and I'm sure some things changed, but I mean, a lot of things I say today that in my mind are kind of more recent things that I say. I was saying them 10, 12 years ago, a long time ago. So kind of funny. I guess you perfect them, and I think maybe you start out saying something and then it kind of gets repeated and gets perfected, and by the time you go through all that, you don't realize how long you say it. Categorize the quote as being a hard quote, meaning a technical concept, meaning about the charts, or a soft concept, meaning psychological or a follow-up type of thing. They're both important, obviously. Which do you think I think is more important? Hard or soft? Concepts in general, not just the quotes. What do you think I think is the most important between hard and soft? Comments, learning, understanding, hard being technical type things, soft being psycho or follow-up type things. Yeah, soft are definitely the ones. And the reason is because, very simply, anybody can learn the technical part of it. Anybody can. I'm not saying everybody does, and I'm not saying everybody gets good at it. Anybody can, and it really requires the education of a fifth grader. It really does. It requires some repetition, so I think for the most part, just some real acknowledgement and attempt to learn it. I think the people that don't learn it well just never really try. They just kind of think, I'll just glaze over it and get the general idea, and that's not what it is. It's kind of like getting the general idea of the law when you go to defend somebody for murder, or getting the general idea of how to do open heart surgery before you do open heart surgery. Not really a good idea. But the problem is with the soft part is the psychological and follow-up. Well, follow-up type things anybody can do. It's just a matter of laziness. Some of the psychological things are hard for people to overcome. Like sometimes there's not an answer. I'm going to give you answers today the best I can, and you've probably heard me say some of these things before. At this point, some words will be repeated if you've listened to everything I've ever said. But even with all the help in the world, some people can't overcome the psycho part of it. They just can't. And then most importantly, that a lot of you will like, every one of these, except one, has a chart example to illustrate what I'm trying to say. So there's actually 4 quotes I picked for today out of a whole mess of them. So here we go. Here's number 1. And I'm going to see if anybody knows what this actually means. A spark can ignite a bucket of gasoline, but not a bucket of water. What a stupid quote. Who said that? This is a hard quote. Does anybody know what this refers to? There are 2 or 3 single words that would describe it. And I would really call this a very I don't know if I call you advanced, but I'd call you a very astute follower of me if you actually know what this was, because I probably only used this analogy in maybe one or two presentations over the years. What does it mean a spark can ignite a bucket of gasoline, not a bucket of water? This is a concept from the chart. No, it's not really a moment in time, no. I mean, anything could be part of a moment in time, I guess, but no, this is a very specific concept. In the right area. Yeah, you're there, Dave, but what are the words though? Like what is a spark can't ignite a bucket of water? What's the word there? Again, I'd really be impressed if somebody said it's probably two different words you could use. Yeah, need fuel, shake it off. Nope. Okay, I'm gonna go on. I don't think anybody hit the nail on the head. This has to do with the concept of self-fulfilling prophecy, which is also known as subjective technical concepts. There's subjective things on the chart and there's objective things on the chart, and you have to know which are which. And I'm not saying the subjective are worthless, but in a vacuum they are. There are many technical concepts that are not real concepts, at least not when looked at individually. Moving averages, for example, are not support, period. Fibonacci and Gann lines are not support, and all technical indicators in general don't give buy or sell signals. These are all squiggly lines that are mathematically drawn on a chart. Some deal with areas of probability or whatever, but none of them are real concepts. What is a real concept on a chart? What is a real concept on a chart? A real concept on a chart is, yeah, but a pattern in what? I think you got it. It's a bulls and bear battling, but it ends up being the price, the actual price. In other words, when big money somewhere steps up to buy something, boom, it stops falling, it reverses, it goes higher. That moment is a price print. That is that bottom, that pivot, that V, that low. That's the objective part of a chart. Somebody bought a lot of stock there. You cannot argue with that. Saying that prices dropped and hit a moving average, and now we buy the moving average. Quite honestly, I don't want to offend anybody. If you're sensitive, cover your ears for a minute. But that's just nonsense. It's just stupid. There's places for everything on a chart, and when a lot of things come together, it can be nice. But any single concept like that. Somebody asked me just very recently what I thought was really a great question, and it was, Paul, all these technical concepts, they really work great and all that, but the question was, does big money follow a chart? And I gave an answer, which I'll give you now, but along the way now I thought of an analogy. And to me, this is the same analogy. Imagine you're tracking an animal through the woods, right? You're tracking an animal through the woods. So we're following these footprints, and they're going left, right, over the log, over the rocks, through the creek. We're following and then the guy I'm with asked me, hey, do you think that animal is following the footprints too? Right? It's the same analogy. Right? I mean, it really is. Now, big money is what's making the chart. They're not following the chart. They're making the chart. And that's why some people feel charts are so erratic or not trustworthy, because they don't understand what they're looking at. They think that, when money steps in, it makes a new chart. It breaks the downtrend, it breaks the uptrend, maybe it takes you out of a trade, whatever it is, but that's all information that we use. But until money changes the pattern, it's following a certain pattern. So it's the actual price pattern that always matters. Now, there's a lot of things we can use as a guide to get to understand, because every time we look at a chart, we always want to know those four things. Who has to buy this stock? Who wants to buy this stock? Who has to sell this stock? And who wants to sell this stock? And we can get a better idea of that by looking at a lot of concepts in a chart and looking through multiple time frames. But it's this concept to me that when you have, let me read here. Real technical concepts come from price action. This is the objective technical analysis. If subjective analysis concepts, self-fulfilling prophecy things. Self-fulfilling prophecy, for those who aren't familiar with the term, kind of means if everybody expects something to happen at a certain point, as people start to react to that point, everyone else sees the reaction and says, oh, it's really working, right? And in technical analysis, it means if prices are dropping to just a ridiculous moving average or something, and that's all that's there. But we had a long drop, right? And maybe some sellers are kind of exhausted. And you say, okay, everybody's looking at it and saying, okay, there's a moving average. Do you think it's going to hold prices? And somebody says, sure, well, I'll buy it. And as soon as he buys it, somebody says, oh, look, it's moving up. I'll buy it. And then you get a string of idiots, Sorry, I'm an idiot sometimes, but you get a string of idiots buying this, and then and of course the idiots don't have real money. They're like us. We just have little peon money. And then the people who were selling this the whole time say, thank you for that, idiots, and boom, that's what happens. That's what self-fulfilling prophecy is. But when self-fulfilling prophecy lines up with real technical concepts, I refer to the self-fulfilling prophecy as a spark. That's all it is. It's just a spark. But if the real chart pattern is there, then that spark can help ignite the real pattern. Does that make sense, everybody? I will gladly repeat that as much as you want. Does that make sense if you heard that? We have a light crowd here tonight. I don't know why. So in uptrend hitting minor support guarantees buyers. A minor support is a hard technical concept. It's a real objective concept. When you hit minor support, you will have buyers there. It's guaranteed. Now, it may also, anything real also become self-fulfilling prophecy, but there's real buyers there. But if we just happen to have a moving average there as well, that's great, because now we have people who like moving averages also participating, right? So there's a moving average, great. And what if there's I don't even know what a Gann line is, but let's say there's a Gann line there, and there's a fan line, and there's an ovular line, and there's an octagon line, and all these different technical self-fulfilling prophecy subjective things, they just happen to line up here. Well, if you have a real chart where you ought to get real buying, it's possible that once you get in this area, once you get in this zone where it's going to be bought, or possibly where big money wants to buy it, let me erase some of that. Possibly here's the buy point again for big money. And while they're waiting to hit it, all of a sudden a bunch of peon traders come in with their moving averages and Gann lines. It starts to move. Well, guess what? Big money's got to step up and chase it. So when you have all of them lining up, it's fine. Now, the detriment to a lot of people who use some of this subjective stuff is that it works sometimes. You know, they say a broken clock is right twice a day. So it can be confusing because you happen to find a good chart, and your Gann line or your Fibonacci line or whatever gets hit, and all of a sudden buying comes. You go, wow, this works. But then you try it on another chart, it doesn't work. Another chart, it doesn't work. You're saying, well, I don't know about all this stuff. You may see a bounce, but it's more likely a shortable opportunity. You won't make money until you understand real price action. Of course, why are a lot of the self-fulfilling prophecy things popular, everyone? And a lot of you know this, right? You go, why are a lot of the self-fulfilling prophecy things popular? The self-fulfilling prophecy things? No, well, they're not good odds. I think you misunderstood my question. The self-fulfilling prophecy things are actually very poor odds, the subjective technical analysis concepts. But people like to use them, whether they work or not, because they're simple and they're easy and they're lazy, and all you have to do is put these magic lines on your charts and things work. So objective is always where it is, and as you know, if you've heard me teach before, I have some moving averages on my chart. They're there for a specific reason. They're not deemed as support or resistance per se. And I really highly recommend you don't put any technical stuff on your charts, because it only gives you a false impression of where things may move. As a matter of fact, I really suggest that you do not put grid lines on your chart. Remember that test do you guys remember the test we did where we had a survey up, I gave you multiple choice answers, and I showed you different charts, and it kind of turned out to be kind of tricky because a lot of the charts are duplicates, but one thing was different, and I got people to answer questions differently. When you put grid lines on your chart, it gives you a false sense of support. It really does. And I proved that on that night because I gave you two identical charts. One had grid lines, one didn't, and the price action fell to a grid line. And way more people said, hey, there's support there on the chart than they did on the chart without grid lines, just because a grid line was there, right? And these are randomly drawn lines. I'm talking about, just putting lines on your chart every 10 cents or whatever it is. So let's take a look at an example of this. Now for this example, to be clear, whenever I pull up chart examples, I like to use trades from the last couple days. I always do that. I don't go back to wherever. So this first one here is different because when I'm showing you a bad thing. So this is not a trade I did. This is just an example of exactly what I'm talking about. And by the way, this chart was not hard to find. As a matter of fact, I didn't even look for it. I was talking to the room about something, and it struck me, oh yeah, I want to look for a couple examples, and the chart I'm looking at right in front of me was an example of exactly what I'm talking about. I mean, every other chart you look at, you could find an example of this. This is an example of self-fulfilling prophecy, things that some people would look at. So the question I have for you here is TiVo on a daily chart. How do we like this buy setup on TiVo right here? How do we like this buy setup? Do you like it? Do you not like it? Take a minute and give me your best answers, why we like it, why you don't like it. Would you take this trade if we traded up a green bar over something? How do we like it? And there are pluses and minuses to this chart. This is not a totally one-sided thing. Maybe the bottom line is, would you take that trade? I know it's just falling still, but assuming we get some kind of a buy over a bar high or something like that, would you jump in? Minor support, but wait for a secondary sign. Okay, so that's good. You recognize there's minor support there. And by the way, I did not put the weekly chart on it with this also, but the weekly chart will affect your answer a little bit on the daily chart, but that's not fair. Minor support is too far away. Like, you mean like minor support is still too far beneath us or too far back in time? Okay. Any other observations on this? This is funny because this is really a great example of this chart, and I didn't even look for it. Got some other people typing. Let's wait and see what we got. Came down a bit hard. Okay. Moved down, began. Stephen, you blew my next question. Yeah. Stephen nailed that one. That's true. Okay. Going to the right. Exactly, Chris. Exactly. Okay. Well, here's the point I want to make first of all, is that you see the bottoming tail there? I mean, it's amazing how many times you'll get that. We landed on the 200 period moving average, a flat 200 period moving average, and here comes the rising 40 underneath it. And a lot of people look at that and say, gee, that's a buy right there. So let's look at the next day what happens. Magic pen on. So we're looking at that right there. And the next day, here we go, boom. Okay, we go below the 200, well, look what happens. Amazingly, while the first day hung onto the 200 like glue, the second day crashes through, hits the 40, and now bounces up. Do we like it more now? Does it look even better now? We've held two moving averages. And if you never heard me talk before and you just tuned in, please don't tune out because I said we held two moving averages. I'm making fun of this. We like it more now? Why do you like it more now? See, that's really, I guess, the key to the question here. Why do you like it more? What's changed? What's changed since yesterday? If this is today, I mean, well, yeah, I know the bar closed green, but that's not an entry concept at all, right? Wide bar, closed above the 200. That's part of my point, Kevin. Closing above the 200 means absolutely nothing. I mean, zero in real terms. Again, it's a self-fulfilling prophecy thing, and perhaps this whole bounce was caused by the fact that we ran into this moving average and then bounced. Do you think the hourly downtrend? Well, first of all, do you agree that the underlying chart is in a downtrend? The hourly chart's in a downtrend, right? Yeah. Do you think the hourly chart is in an uptrend now? Well, I can answer that question for you. No, it's not. Before I go to the rest of how this develops, let me review here. Those of you that said that there's minor support here, it's true. And that is the redeeming factor here. That's the one redeeming thing. There's minor support there. And that's a real thing. That's a very real thing. As a matter of fact, it's my favorite thing of all times. If you look at the weekly chart, naturally, there's minor support on the weekly chart. The weekly chart is totally downtrending, and this is the first break of the weekly downtrend. Now, you don't have the weekly chart in front of you, so I won't talk about that anymore. But what I don't like, and I never like, is this big wide pattern. You have this huge move up and this huge sloppy pullback. These typically just don't hold. And especially when you have, what the two of you pointed out, that gap in the pattern there. When you gap away, this is kind of a congested top up here. And then when you gap away from that, all these people are trapped. And yeah, I keep having the weekly chart in my head. Because it's the first bounce, it's a transitional weekly chart, and you don't see that there, but the weekly chart is like this. It's been downtrending, 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 and this is the first time we popped above a prior low. So it's transitioning, but what happens in transitions is you typically get whacked back further than you think you're going to. They always come back deep because it's that first pop. A lot of that pop is sometimes short covering, whatever. So the technical picture on this, I don't like much about this at all other than the minor support. And of course, this is not, just to be clear, this is a pattern I would never try to buy. Never, not right here. This is the type of pattern you want to see more proof that it's going to hold. What I thought was amazing was that it bounced off the 200, it bounced off the 40. And again, these are just little tiny bounces. If you're playing the daily chart, you're not making money on that. These are just people that are, kind of getting sucked into the trade. And then the next day, what happens, of course, is that day gets reversed. And again, we hold right on the moving average. Isn't that amazing? And then we hold the moving average again. And boy, there's that chance to get long. And here it comes. Now we traded over a bar's high, right? Got to be good. And no, it's not good. I think that includes today. Well, that was captured early today, so I don't know. We probably rallied back some from there. But this is the type of pattern a lot of people get stuck in, and a lot of it comes because of the perception that these moving averages. And the only thing I don't like about this example is I wanted, as I'm doing it, is that it would be better if the moving averages were in a total vacuum, just in the middle of nowhere, because they wouldn't work at all. But here, I think the chart pattern is poor enough that even though there's that minor support level there, nothing here to help it. So you want actual price action to be your guide, and you don't have it here enough, moving averages alone, or pick anything else you want. By the way, there's also probably a Fibonacci retracement right in here. I forget the exact number. It looks pretty close, though, to being a fib retracement right there, right? That's got to be really close. That's right there. Doesn't work, and you can pull out whatever other stuff you want as well. So that's my example for that one. Spark and ignite a bucket of gasoline, not a bucket of water. Again, that simply means that when you have a spark, which means subjective, self-fulfilling prophecy things, they can ignite a move when technically the move makes sense. But when the technical pattern isn't there, all these other self-fulfilling prophecies, subjective things, which includes all technical indicators, moving averages, all that stuff, none of it's going to work. None of that supports a pattern, okay? Well, let's move on. So that's number 1 out of 4 anyhow. Next one, quote number 2. And this is my quote, purely me, and it's been around, I've had around for a long time. Taking a lesser quality trade just to trade is the mark of a novice. Now this is purely a soft comment. Is in the category of psychological comment. It simply refers to discipline. Well, actually, knowledge comes first, then discipline. Here's the funny thing with a lot of discipline type of issues, and that is discipline is always made easier when you know what you're doing. Would you all agree with that, everybody? The more you know what you're doing, the easier discipline becomes, right? And when you're just, playing craps with the dice, discipline's tough because you're not as sure as the outcome, you're not as confident. When you have part of any trading concept is that you're going to have winners and losers, right? You're never going to go without losers. And a confident trader knows, hey, loser, it's okay, I'll be back. An unconfident trader thinks loser, oh, I got a problem. And then they start changing everything they do. So it's hard. I mean, a lot of things are mostly psychological, but almost any psychological problem is made easier or is conquered by having a better grasp on what you're doing. It's just the part of it. So this one, though, is close as it can get to being pure psychological, because this one here just refuses to discipline to wait until you have something to trade, which a lot of people have a hard time doing, right? Naturally, the first issue is to know what a lesser quality trade is. Think about that. Right? Think about that in a vacuum. Just to picture a newer trader, maybe yourself when you were newer, maybe you are newer now. And I say, don't take a lower quality trade, and you go back to trade and you scratch your head and you go, wait a minute, what is a lower quality trade, right? I mean, there's the first issue. How can you follow this advice, which is in the psychological category, if you don't even know what a lesser quality trade is? And by the way, lesser quality trade may vary from person to person, but of course the bottom line is you need to be making money. And if you're taking all trades and bottom line you're not making money, you're probably not taking quality trades. You may never encounter this as an issue because you may not feel your trades, because you may feel all your trades are great quality. They just don't work for some reason, right? That's a common thing I hear a lot. My trades are all fine. They're just not working. I don't know. That's like me golfing. I got really mad because the PGA should have let me play professional golf, because every time I'm in the fairway, I hit the ball pin high. It's usually 150 yards to the left or to the right, but so what? That's just one little thing. It's always pin high. That's what some traders talk like, I had a great trade, but the market ruined it. Oh, the market ruined it. That's not part of your concept when you trade what the market's doing. Even after knowing what quality is, there's still several things to set in. So here, even if you understand quality, so the first step is taking a lesser quality trade is the mark of a novice. Great. First issue is, well, you have to understand what a quality trade is. You have to understand good from bad trades, know what you're doing, some kind of plan, a good understanding, technical analysis. But then step two is even people that have that will sometimes still take lesser quality trades rather than do nothing, right? And that's because of FOMO is the fear of missing out. I sent an article out that said FOMO, and somebody had to email me back asking what FOMO was. I felt kind of bad I didn't explain it, but it's not a technical term. I mean, FOMO is an advertising term, isn't it? I mean, I never knew it to be a chart term, really. We use it in charts, but I thought it was an advertising thing, fear of missing out. But anyways, fear of missing out of a trade, makes people jump in because they say, oh, what if this rallies here? What if this turns out to be the best trade of the week? Oh, I don't want to miss it. Anybody ever think those thoughts to yourself? Anybody ever think that way? You're debating a trade, and part of the process, seriously, anybody ever think that way? Part of the thought process is, gosh, what if I miss this? And actually, it's not bad to think that way necessarily, as long as it's in balance with everything else, right? I mean, obviously, we want trades we think are going to work real well, but you have to put it in balance with the odds of it working, and everything else. And what if it stops? And how mad are you going to be if it does stop? So the problem is for the people who have that constant fear of missing out, or just purely a lack of patience. I got to be doing something, right? Got to be in a trade, got to be in two trades, got to be in three trades. I'd rather do something than nothing. You can't make money unless you're in the trade. Changing standards is kind of the same concept. It just simply means you're sitting there. And again, this applies long-term or short-term. It doesn't matter. If you're day trading and it's 10 o'clock and you haven't found a trade yet, you start going, well, wait a minute. Give me something. You start maybe changing the standards for the trade that you want to take because you want to get something. But it applies long-term too. There are times the charts get really sloppy. You're looking for something. You decide, boy, I want to get something long. Just give me anything. And you jump into things that turn out to be regretful. As a backup to this, I put one of those quick tips that went out to you a while back. And I really like this one. And I'd like you to know how many people who teach this would say this comment. I say a lot of things that people don't say. It's okay to be wrong and to lose money, even lose more than you like, when you have a strong conviction and following your plan on a high odds trades. Think about what I just said there for a minute, right? Have you ever had anybody tell you it's okay to lose money, even lose more than you like, as long as you truly had conviction in the trade? You ever heard anybody say that? I think it's important that you hear it and understand it because it's true. Because how do you make money, guys? How do you make money unless you go all out conviction on what you're supposed to be doing? We're not right all the time, right? But if you're constantly always hedging and weighing your bets and, being too careful, you never make money. And that can be a problem. You're wrong, you lose money. But then when you're right, you don't really make any money because you're always trimming it down and being careful and all this. I mean, when you have the trades that are right, boom, you go in as big as you're supposed to, whatever that is, and you stick to your convictions. And if you're wrong, you know what? You're wrong. It's what a stop out is called. But you don't hesitate, you don't double think it. So it's okay to be wrong and lose money even more than you like when you have a strong conviction and following your plan on high odds trades. Sometimes you are wrong and you cannot be afraid of being wrong. Think about that. You're going to be wrong. You can't be afraid of being wrong. You got to go in and say, man, boy, got my head handed to me on that one, but that's okay. And naturally you follow your money rules and all that, but I'm just saying it's okay to go after something. But it is a sin to lose more than a minimal amount when you have no clue. Right? You're just out there swinging at anything you can see. That's a sin to be doing that, right? Now, when we're in the room on days, I've had some days I've done no trades, but generally I'll say, you know what? I'm going to try and find one thing, and see how it plays out. I think we're going to drop today. Let me grab a short and just let it go for the day. Just take a trade, and if things go my way, it could be a home run. If not, I'm done because I just don't see the setups today, right? So I thought that was a good backup to this, right? Yeah, absolutely. Yeah, Dave, I mean, you're so right. I just don't want to keep harping on the fact that people, have to know charts and have to know what's going on because, I've said that a lot, but you're absolutely right. All this is a silly conversation if you don't know what you're doing or what you're looking at or what to trade in the first place. So many people just don't understand what great odds we have, right, Dave? When you know technical analysis, the odds are just really great as long as you follow what you're supposed to be doing. Most people never get to that level, though. Well, yeah, exactly, Gary. That's, I think, probably covered by what I said a few minutes ago, that, the first place right here. The first issue is to know what a lesser quality trade is, right? I mean, that's the first issue. Like I said, if you don't know that, all the rest is a moot point. What's sad, though, is people can learn what a good trade is and then still not maintain their standards. I've explained it in other ways, too. I kind of likened it to owning a casino, or let's say you're allowed to run one table. Let's say a casino rents a table to you and you can be the house for one table, right? You have 52 to 48 odds. That's not really great, right? I kind of look at trading that way. Even at its best, we don't have great odds. I don't look at a trade and go 90% chance I'm making money. It's more like a casino type of thing where you're saying, hey, odds are I'll win over time. But what if when you're running that table and you have 52 to 48 odds, that's what you have in blackjack, and you own the table, so you're the house. What if you hire a dealer, for when you're not there, or you hire a dealer for all the time? And what if you don't check on the dealer's background? What if the dealer turns out to be crooked and he's stealing? What if the dealer turns out to bring his buddies in and he's, whatever you do to cheat in blackjack and his buddies are winning? Are you going to make money at your table? The answer is no, you're going to lose, right? So here you have a guaranteed winning thing, but yet if you don't do what you're supposed to do, you're going to lose. And it's the same thing in trading. I mean, if you know what you're doing, it is a guaranteed winning thing. But the problem is a lot of people either don't know or don't follow what they're supposed to do. Hence, some of these great quotes that we're looking at tonight. New traders come to the market 100% subjective. Getting an understanding of the language of charts starts with to transform subjective to objective. Mastering the language of charts gets you to understand the objective part like a master. And then to understand that last little bit, will always be subjective. Remember a couple of Saturdays ago, we got together, and one of the things I showed you was I got you guys to split 50-50, or theoretically could, about whether a single candlestick was bullish or bearish. Remember that? Anybody there for that? It was the last Saturday event, the last DTS. I got you to split 50. I put up a candlestick. We voted. Everybody said bullish. Everybody said bullish. Some said bearish. Some said bearish. And then pretty soon you're 50-50. You couldn't even decide. So it proves to me that obviously there's subjectivity in the market. There is to some degree. Of course there is. But we have to make it as objective as possible. But that whole little thing I just said is where the catch is for a lot of people. That they either try to think it's wholly objective and therefore use technical indicators or green-red software or other garbage that doesn't work, or to the extent they know there's some subjectivity, they don't have the skill to handle that subjectivity, right? There is no absolute answer to this quote or to this problem, taking lesser quality trades just to trade as a mark of a novice. I can't refer you to a thing, a comment. At some level, it becomes discipline, right? But initially, it's knowledge, right? How can you stop doing what is wrong if you don't know what is wrong? So the formula is get to know what you're doing. Knowledge leads to confidence. And that's the only way to have discipline, really, right? When it comes to the discipline part, a lot of times discipline comes down to just what's between your ears. There's some people that will never have the discipline. They just don't have it in them. But to even have a shot at having the discipline, you have to to know what you're doing. So if you're not ready to get formal training, or if you never want to, you're just learning for yourself now. I find a lot of people just kind of learn for themselves for a while and then eventually come and maybe take a seminar program, whatever. But whether you're waiting or you just want to learn for yourself, period, or that's all you ever want to do, the best stuff for you now is to get as educated as you can. And the best source I know is what I consider to be the best source for free information on the internet, and that's at the DTS free stuff page. If you go there, it's a daunting amount of information, because not only do you have all the videos there, but there's the archive page. So it goes back to 4.5 years of events and Trade of the Week videos. But I suggest you start off with the Hall of Fame. Just go right to the Hall of Fame on the DTS website. As a matter of fact, for those of you that haven't been there, I always think everybody's been there, but then I talk to people and find out, nope, barely looked at the free stuff page. You could spend an entire week on the free stuff page and not be done. This will take you directly to the Hall of Fame. But if you go to Hall of Fame, those are the 4 videos that were voted by you guys. That should take you right there to the Hall of Fame. But these are videos that were voted on by you guys, by the DTS members a while back, to say these are your favorite videos of all the ones out there, and I can't disagree with any of them. So look those over. Quote number 3. We have 2 quotes to go. Most all trader success will eventually come down to their management. Management's a big topic. Maybe people in the past have said something similar. I don't know. But you probably know, if you've heard me talk, that to me, management is where it eventually comes down to for everybody. Yeah, you got to know the charts, and you certainly can't manage if you don't know the charts. So you got to know the charts to know what to play. But again, even people that know what to trade will sometimes still lose because their management is so terrible. And by the way, I went over this at the last event. I'm not going to repeat it here because we're not going to have time. But I went at the last event how you can simply determine if you're a bad chart reader or if you're a bad manager. So go back to the last event and take a look for that if you want to hear that. Unfortunately, this is both a hard and a soft topic to me. I'll explain why in a minute. A huge part of the GTS seminar program is about management. Managing to get to a target, managing an entry, managing a stop. And the point of me saying that is that there is a lot of hard information to learn about managing. A lot. To me, it is by far the better part of technical analysis. In other words, when I teach, to me, this is where all the money is made. This is all the important stuff. And I'm not just talking about managing, I'm talking about, when I teach, it's managing stops, managing entries, and then managing also to get to a target. So I think there's a lot of information to learn here. But again, people can learn that and still goof up. Management can become a bit of a science. It is first an issue of how to manage, learning it. And a big part of how to manage is the follow-up. This is something else people don't realize unless you've been through seminars with me, but a big part of management has to involve you following up to see how you're doing on your personal trading. And unfortunately, the biggest issue for most traders is not the above, learning what to do. It is actually doing what you're supposed to be doing. When you learn the management concepts, and again, this is the type of concept, learning to manage, that once you learn it, it's not hard. You look back and you say, okay. And it's something maybe you could or should have figured out for yourself. Most people don't use any good management concepts. They don't know them. But once they learn them, they are not hard to understand, is my point. So what happens when somebody takes a trade and totally mismanages it? And they knew what they were supposed to do? Everybody. Do you think for most people that the problem was A, the management process was too complicated, they couldn't figure it out, and therefore they lost money, or B, they just didn't follow it because they started getting all emotionally involved in the trade? A or B? A, is just too difficult to follow a management concept, or B, well, you knew what you're supposed to do, but you just couldn't hit the sell button, hit the buy button, whatever it was. Or a lot of times the more common problem is you're hitting the sell button way too early, right? You get a great trade, and what do you do with it? You just take the money very, very early. Virtually all psychological issues in trading involve the management process. Some skill, you need some skill, you need to build confidence, you need to learn some tricks. But at some point, discipline is between the ears. It is, Dave, I know. I mean, whenever you figured that out, I'm sure it was probably, you heard me talk about it for a while before you actually discover that for yourself. It's always the case. One of the most common things I hear is, I heard you talk about that for so long, and I finally took it to heart, and wow, I wish I would have done that a year ago. That's what a lot of people say. Prior event to watch to get more information on this. Tips on management is on the free stuff page. Again, your example A. Tips on management. Again, remember, for a lot of these, you got to go to the free stuff page. And when you go there, I can't see the date on that, but it was a while back. But if you're on the page, you can just search, Control F on the page and go search management, and then it'll take you to wherever you are on any website page. So let's do an example here. And again, trade examples I use are always from the last couple of days. So this was on Monday. This is CAG, and this is an example of management, right? And this is something I'm big on. When you have a decent trade, you have to make money from it. Good money the majority of time. Now, you're going to have times that you misread the potential, that you got the wrong zip code, you misread the target. Maybe your management plan that you used didn't get you to the target you want to. You're not always going to get maximum money out of a trade. But here's a question I have for you. How often do you get maximum money out of a trade? Some questions you should ask yourself if you're breaking even, which is where a lot of people who listen to me are stuck a lot of times. Good question to ask yourself is, what's your batting average? 50%? Okay, if you're batting 50%, then the question I have for you is, how many 3R trades do you have? How many 2R trades? In other words, how many times was your average target, your average exit, the money you made from your exits in total? How many times was that triple what you risked? If you risked $100, you made 300 out the door. If you risked 1,000, you made 3,000. How many times do you have that? That's something that should be top of mind. Now, I'm not saying you have to have big winners. You don't have to. You can have an average of 1.5R winners if you're batting 60, 70%. But a lot of traders, if you're batting 50%, which is fine, 50% is a good number, as long as you have a lot of bigger winners mixed in there. So that's one of the questions you have to ask. And the problem, of course, comes down to this, is how many trades did you have that were big winners, but yet you walked away with not that much? Does that make sense, everyone, what I'm saying? Again, this is one of these, in my head, doing this for years, teaching it for years, this is such a big point. Not a lot of you typing out there. This is such a big point. But I'm not sure it always hits with everybody. When you have a trade that works, you got to look back and say, did I kill it on that trade? Did I make good money on that trade? Because if your winning trades don't make much, and then you have losing trades, well, how do you make money? And when do you change? Here's where this problem comes from. Let me show you just quick on CAG. So CAG here, when you have decent money, you have to make money. So entry there on CAG, and you can see the numbers up here. This is on Monday I did this. Entry under 34.89, and then ended up with one exit, 33.93. I was going for one target, which was the prior low on the chart, and it was a little below that. I forgot what it was. It was maybe 33.70 something, and then at some point I put it in a trail there. So ends up making triple the risk, a 3R trade, and this is just kind of not sitting there watching it most of the time, not sitting there watching it. To the extent I was sitting there watching, if you're sitting there watching this, look at this comment I said. It said, even a bad technical chart reader could follow this chart to a target. What did I mean by that? What did I mean by that? Even a bad technical chart reader could have followed this to a target. Look at that chart. Yeah, this is just the tightest little pattern that I'm saying even the jumpiest person sitting here shouldn't have been out of that, right? But my question to you is, would you have been out of it? I think you may find a lot of times you are. Now, this is a unique chart in that they're not normally like this. A lot of times you get bigger bounces, right? Right? And you get little things happen, and you go, and then at the end of the day, you're out way up here, and you go, oh my gosh, I made $300. I would have made $1,800, right? You ever have that happen? You would have micromanaged yourself out. Yeah. I want you to really take to heart, guys, what I'm saying. I mean, just trust me on this. You come to listen to the free advice, whatever it is that unless you start making money from your winners, you're going to be out of business. Think about both how profound that statement is and how ridiculously obvious it is, right? Isn't that true? On one hand, boy, that's profound, Paul. But on the other hand, it's like, well, what do you expect, right? You have winning trades, you have to make money. And if you can't change that, you'll be out of business. You're just kidding yourself. You can't say, and let me take you on this next slide here. Let me take you to the thought process that I know happens to a lot of you. And tell you what, you type a number 1 on the screen whenever you feel I'm talking about you. Here's what happens to a lot of people, right? I'm nodding yes. you start your, I don't care if you're long-term, short-term. I'll take day trading. You take your first day trade and you get stopped out. You're down one risk unit. You're down $500, whatever you risk, you're down, right? And hopefully you're not risking any significant money until you know how to trade. But let's say you're a good trader, right? And you're up there. You've earned the right to risk Let's say you risk $500. You take a second trade and now you're down 2. Oh no. Doesn't feel good to be down 2, right? Then you take your third trade. You know what happens? It's doing well. You're up 1R. You're up 1.7. You're up 1.8 Rs. You're up $850 of the 1,000 that you've lost. What do? What does your brain start telling you to do? That idiot part of your brain. What does it start telling you to do? You all know because this happens to more than a couple of people. You start thinking to yourself, you know what? if I get out here, that'll pay for those first two losses. I'm only down $100. I was down $1,000. I feel pretty good about that. Let me just get out and start over, right? And if you do that, you know what you've just done? And of course, the idea is that out of 3 trades, maybe 2 stop, but the third one was the one that made 3 R's and you made your trading day, right? But you'll never know that, right? Yeah. And the problem with this is, I want you to think about this also. If this is what you're doing, if you're taking enough of a winner to pay for your losers, you are intentionally and absolutely trying. Your goal is to break even. You ever think about it that way? Your goal is to break even. That's what you're trying to do now. Just pay for your losses. What good is that? Who wants to sit here learning this so that you can break even, right? You have to leave the subjectivity out of it. It's hard sometimes, you know. It's hard sometimes when your management plan that you have, you can't capture every penny of profit and also get to big targets, right? You can't get to a target like this and not give back some profit, right? When I'm down here, right? I can't, in other words, if I'm down here and maybe my stop would have been here or something, if that comes all the way back, I'm like, oh my gosh, I gave back, you know, 3/4 of my profit. That's painful, right? But if you're always going to immediately get out at that, you'll never get this, right? Does that make sense? So you have to decide what you're doing and how you're doing it. And there's different plans that can work, but you have to have one that you follow. So if your plan is always to get to here, but then you get out on any little thing that happens without rhyme. Now, I can't kid you. There's times, you know, I get out of something earlier than I should have because I misread it, I misjudged it. I didn't think the target was that big. I got nicked out, whatever. Maybe I was influenced because I was having a tough day and I said, boy, you know what? I want to protect some of this, and then, you know, stuff happens. But in general, I know what I'm doing. I come out well. And that's the problem when you're newer. You maybe don't know how to do that. So management is what is eventually going to make or break you when you come down to it, right? This concept, you can't go broke taking a profit. I'm sure you've heard me talk about that. And again, go look at your trading records and ask, if you are in the 50% batting average, which again, I just think a lot of people are, and there's nothing wrong with that. Go back and take a look at your charts. How many times have you had a 3R trade? A triple risk trade? How many times have you had a 2R trade? How many times do you actually make more than you lose in general? You may get sick when you look up that number. And by the way, you should know that number. You should know that number every day that you trade. Most people do not. All right, on to number 4. This is definitely a Paul quote because it doesn't even make any sense. Don't chase shiny objects. Make money from normal moves. This was the subject of a prior event a long time ago. So again, if you go to, I don't think I put the video here now. So if you go to the website and look up normal moves, I think the title had the word normal moves in it. It was probably called Make Your Money from Normal Moves. So you can get more information about this. But again, this is about great quotes and about sayings. And, you know, don't chase shiny objects is, I think, the funny part of the quote. And then the back half of it is make your money from normal moves. This is, again, both a hard and soft, because make your money from normal moves is a hard topic. What do you look for? What charts are you talking about? Where are we going? Don't chase shiny objects is a soft concept. Again, I just, because I get charts from people, because I get people in the trading room all the time and new people, and it's just such a common thing to try and go after the most difficult trade in the world. You know, it's something that gapped up 20% and it's in the middle of nowhere. And is it going higher or lower? And I'm like, I don't know. And of course, at the end of the day, you look back and you say, oh, well, if I took this one long, I would have made a whole week's profit. If I took that one short, but you know, that's at the end of the day. The point is, at the moment it's happening, we really don't know on some of this stuff. You're not supposed to know where every chart's going. You're not supposed to know where every gap is going. As a matter of fact, I'm sure you've heard me say 97% of the time, I don't know where a chart is going. I'm looking for that 3% where the chart comes out and tells me, hey, I know where I'm going. I know which way to go. And then I get some entry concept that makes the risk reward make sense and everything else. Shiny object refers to the crazy stock of the day, gapped at 20% and moved 40% yesterday. Yes, you can make money from them, but it's hard. Why do you want to do that as a rule? Don't chase shiny objects, make your money from normal moves. Trading should be boring. Yes, I'm sorry. It should be boring. I should have asked that to those of you in the room with me because we all know it's boring. The only thing that saves the people in the room is that I tell a constant stream of hilarious jokes, and I'm very humorous throughout the trading day, and that keeps people from being bored. But if it wasn't for my sense of humor, people would be very bored trading with me all day because we don't do much. We just look at a list of stocks, we find our entries, and we go home. Nobody's nobody's commenting on my humorous comment. Many traders go for the home run or the super volatile stock. But the super big move requires a super wide stop, and it's more likely to stop. And most importantly, when you get the home run, do you actually take it? Gary, you have to pay the big money and be in the room to get the humorous anecdotes. Most importantly, when the home run comes, few take it. They take partial profits, making the whole concept a poor one. So again, I'm okay, and I actually like the whole high risk reward trading concept. But it only works when you take your profits, when you actually, hang in there. So if you're trading the crazy biotech stock of the day, this is a little stock that just, has been between $1 and $2 for the last 5 years, and it just gapped to 4, and you get in there and you get a 50-cent stop, and then, it ends up running to 7. Congratulations, you made your trade. But what's the problem? The problem is, again, you're out at 5, and yeah, you made an okay trade, but it doesn't pay for all the losers you have when you're trading this crazy crap like this. So, if you're good at it, I never said not to do it. I'm just saying that you should make your money from normal moves as a normal concept. Now, the little home run trades, I'll go for them once. I never chase the shiny stuff. I never do that. Right? You guys in the room, how often do I do the crazy little crappy stock of the day? How often do I do that? The CCLPS D, CLPS CD. I don't know the acronym. The crazy little crappy stock of the day, huh? Rarely. Once a month, right? Once a month. Go after crazy stuff. Twice a month, all right. Twice a month, I think I try to get an entry. I'm not sure I get an entry more than once a month, but between once and twice a month. But I don't like them at all. Now, once in a while, though, I will gear up for the home run. I'll find some great little entry and keep the stop kind of snug in that area because I think that's really it, and kind of go for the home run. Like even I think the next one coming up the next one coming up is a bit of a home run. Kind of went all out on it. Virtually all psychological issues in trading are involved in the management process. If your stock is a liquid, I think it's a mistaken line there, sorry. If your stock is liquid, a 40-cent movement with a 20-cent stop makes exactly as much as a $4 move with a $2 stop. Anybody want to question that math? Does anybody not understand that? Just get a boring old stock that moves 40 cents every day of its life, capture that 40-cent move with a 20-cent stop, and you've made as much money as taking the crazy little crappy stock of the day for $4 when you had to use a $2 stop, right? Going for the occasional home run can be part of your plan, but your bread and butter should be from simple, boring trades. Want to see a simple, boring trade? You better drink some coffee first and prop your head up on your hands. Maybe turn on the TV. This is yesterday. This is rig yesterday. I'm going to take you through 3 charts to make the point that I want to make. Let's just take a look at the trade first. The strategy came off the hourly chart. For lack of a better term now, it had to make sense on the daily chart. So here's an hourly chart, and I'm taking my entry right in there. Now, you're not going to really see the entry. If you look for those numbers, you won't see it on the hourly chart because the numbers didn't come from the hourly chart. But entry at 375 and a stop at 367. And I took 2 targets that actually came kind of back to back because it made it to really what I consider the ultimate target. $4. Why was this the target? Why was this the target right here? Anybody who's taken Crackerjack Technical Analysis 101 could answer this question because that's how simple it is. Why was that the target? Yeah, it's just because we're sideways, right? That's all there is to it. We're sideways here. So to get a little better view, how did I set this up here? Hang on. To get a little better view of the trade, I want to show you, this is an hourly chart. So from the entry point here in this run up, right? Let's look at the 5-minute chart. There's the 5-minute chart showing that same run, okay? So entry inside of here, and there's the run on the 5-minute chart. Now again, this is really nice because this run, it was hard to mismanage that, right? You'd have to be, I think even if I was blind in one eye and only had one arm, I probably could have done this, okay? Entry right in there. Now, again, the entry actually didn't even come from the 5-minute chart. The entry for this hourly chart setup came all the way down to the 2-minute chart. The entry came inside that 2-minute chart right in there. Boom. So this is kind of a little bit of a home run trade. I was basically using the stop was just a little bit underneath the low of that area in there. So got lucky, just went up immediately. But it's a really nice setup. It's a nice chart all the way around. So you saw the hourly chart. You see the 5-minute here. This little zoom down, this 2-minute, that arrow is showing you where the entry was. Boom, right in there. You can see the numbers up here. Again, another triple the risk trade. And this one happened to be all done in an hour or something like that. What was it actually? It was, yeah, an hour, just under an hour. But here's the point I want you to make. The point of this, again, what's the title here? Don't chase shiny yacht. Make your money from normal moves, right? Look at this, right? This is nothing spectacular. If you look back at this chart in a few days, you just go, okay, well, it's just flopping around there, nothing special, right? Just a normal. Now, here it fell that distance in one day. Here it rallied. This is the same amount on this day. This day I wouldn't have known to do that. But this is just a normal everyday move. Very liquid stock, finding the right entry point, and boom, half hour, hour. That's what I look for all the time. Boring, boring, boring. It's funny because the money in the account never seems to go to different accounts. It's not like the boring account and the funny. It's all money. It doesn't matter how you make it. Are there any questions? Coming up, we are still finishing the last seminar program. This Sunday is Mastering Gaps. So the next session doesn't start till June 3rd. So that's a month away. So the next Introduction to Mastering Technical Analysis class that you're all invited to that's free is June 3rd, Friday. And that also starts the next series of seminars. Hope you enjoyed this one. I kind of like this one. I don't know why. Sometimes I like things you may not. I didn't send any preliminary scouting comments about whether or not you like it or not. But have a great evening. We'll see you whenever I see you next. Take care.